Welcome to a special edition of Coffee with Scott. Today I'm honored to be joined by my long-term friend and colleague, Chris Doucet. Chris has been with our firm since 2006. He started his career as a bond trader in New York. Today he's a wealth manager and runs 3 separate fixed income strategies for his clients. And so welcome, Chris. Glad to have you here today on Coffee with Scott.
Scott, it's great to be here with iced coffee with Scott today.
So, Chris, let's just dive right into this. So, what would you say are the essentials for realizing better returns in fixed income portfolios?
Throughout my career, I've realized there are 4 basic ingredients, I think, to outperform the market at some point. Number 1, first and foremost, is preservation of principal. If you lose money, you're probably not going to outperform the market. The second thing is you have to get investors closer to the product. You have to eliminate several layers of costly people in the model. So that's the second most important thing, I think. Thirdly, every time you buy a bond or a fixed income security, you have to have a positive asymmetric risk-reward profile. In other words, you have to have multiple times more upside than downside in that particular security pick. And fourth and finally, whatever security that you pick has to outperform the market irrespective of where interest rates are or where they're going.
Okay, I understand preservation of principal, but how do you get an investor closer to the end product?
The model that we use, and we'll put this up on the screen, is this. So the fixed income market has been the same since the early 1900s, late 1800s. And the model hasn't changed. The difference is we have computers now. The bonds are generally traded on the secondary market, and it's an over-the-counter market. Sometimes it's very efficient, sometimes it's very inefficient as a result. And so what we do, and what investors should try to do, is go out to the auction markets and buy bonds at auctions on the secondary market. And as I said, sometimes these auctions are very efficient, sometimes they're very inefficient. We do the research, we actually go to the auctions on behalf of our clients. The problem is, at traditional firms, let's say it's a large wirehouse, they might have 13,000 brokers. They might have, each broker has 300 different clients. So you can see the magnitude of the problem for a bond trader at a big wirehouse. It's going to be difficult to do. So if the bid is typically 99 bid, or where you would sell a bond, by 100 offer, or where you would buy a bond, that trader has to go in there at 99.5, let's say, all day. And then by the time the bond gets to the client or the end user, after all of the markups, the yield might be, or the price might be 100.5. Our model is a little bit different. So if the market is 99 bid by 100 offer, we bid all day at 98.5. We don't buy a lot, but what we buy very, very cheap to the market and bypass a lot of layers of costs and put it directly in the customer account.
Great. So how else can investors gain positive traction in their portfolios?
There are a couple of ways. If we could put the next chart up on the screen, this is something that we came up with a long time ago that we follow on Bloomberg every day, but you can do it at home too, in your own way. But what we do is we follow the 8 major fixed income classes, which have about 22 subclasses in the fixed income market. And as a general rule, what you can see is these fixed income classes fluctuate together. If they go up, and if one goes up in yield, they all go up in yield. If one goes down in yield, they all come down in yield. But what you can see with the lime green line on your screen there is every once in a while, a fixed income class will break from the pack. And you can see here at this point, we generally focus on that particular asset class and buy that particular asset class in the portfolio. And ultimately, it reverts back to an historical mean. And if you can put the next chart on the screen, so we already showed that the importance of trying to buy things at the bid side of the market or below the bid side of the market. And you can see by this one bond that we purchased, you can see that we bought it several points below the marketplace. And we put a bid that we didn't think we were going to buy the bonds, but we actually bought them and provided clients value. So those two things combined are the main ingredients that we use in order to gain advantages in the marketplace for our clients.
Makes sense. So in what ways can investors protect their portfolios from the downside?
Well, we use three different methods to protect clients on the downside. So if you look at the Bloomberg index right now, which is or aggregate index, which is the main index for bonds. So when they quote bond performance, they're generally quoting that particular index. The average maturity in that portfolio is about 8 years. So if interest rates go down, that portfolio is probably going to do very well. If interest rates don't do well, obviously, and interest rates go up, that portfolio is going to do poorly. So what we decided a long, long time ago is we were going to take a different tact, and it has served us very well. So as a general rule, our portfolio is anywhere from 40 to 60% of the duration of the ag. So we're buying much shorter bonds, in other words. We also do something to embed liquidity within a portfolio to give us flexibility. Flexibility in case we need the income from the portfolio, but flexibility in case we see opportunities that we want to take advantage of in the portfolio. And we do it through a simple laddered bond portfolio. And a laddered bond portfolio, an example might be if you have $1 million, and what you do is you divide that into 5 different parts, $200,000 pieces, and you have $200,000 coming in 1 year, $200,000 coming in 2 years, all the way to 5 years. So you have a 5-year bond ladder. But your average maturity is 2.5 years. And every year, you know that you have 20% of that portfolio to either spend or reallocate into something. So you have built-in liquidity. And the third thing that we do, and I think maybe the most powerful thing that we do, is there's something called a barbell structure in the fixed income markets. And basically what that is you take half of the money in the portfolio and you buy maybe very short-term maturities. So you always have liquidity in the portfolio. And with the other side of the barbell, you might buy very long-term maturities. And those long-term maturities are subject to interest rate fluctuations. We have a different tact. What we do, and we think it's much more powerful, is we have very short-term bonds on one end of the portfolio, aided by the laddered portfolio that we just talked about. But on the other side of the ladder, we actually have this opportunistic approach to investing, and we buy things that are out of favor, like that yield rain dance chart that we just put up on the screen. So those things combined have helped us not only outperform the market, but in downdrafts in the market have helped protect principal and keep portfolios more steady in value.
Thank you, Chris. That's good information. So thank you, everyone, for joining this Coffee with Scott. Please be sure, if you enjoyed this, to like and subscribe. See you next time.